Hi, everyone. Welcome to today's deep dive. We're going to explore a really dynamic area, how shareholders actually influence corporations.
And also how companies themselves are, well, grappling with their impact, on society, on the environment. It's huge.
It really is. It's where you see these big ideas about the purpose of a business clashing head on with real world stuff, climate change, executive pay, all of it.
Exactly. We'll look at how the corporation itself, its structure, actually enables this, and how investment trends are, pushing things one way and then getting pushed back.
Right. So our mission here is to unpack all that complexity. We want to look at the core ideas, sure, but also some compelling real-world examples.
Yeah, show how corporate power, responsibility, investor interests, how they all intersect and interact.
And you'll see it's definitely not as simple as just saying companies exist to maximize profits. There's a lot more nuance.
So maybe let's start by laying down some groundwork, some key concepts.
Good idea. It probably all starts with shareholder activism, doesn't it?
It does. Broadly, that just means shareholders taking action to influence a company's behavior or its policies.
And we often think of the, let's call it classic shareholder activism.
Yeah, historically, that was almost purely about the money, right? Financial performance, company strategy. Maybe the CEO wasn't doing a great job
And the ultimate weapon in that fight.
firing the CEO. The shareholders voting them out. That's the biggest stick they carry.
We've seen that happen. Unilever CEO Heinz Schumacher gone pretty quickly, and you had activist investor Nelson Peltz involved there.
That's a perfect example of the classic playbook. Pressure leads to change at the top.
But you mentioned things are changing. This activism is evolving.
Hugely. There's been a really significant shift. Now activists are bringing in environmental, social, and governance factors, ESG.
Ah, so it's not just about the immediate bottom line anymore.
Not always, no. You have different groups of shareholders, often pushing on climate targets or labor practices or how diverse the board is.
And that must create some tension, different shareholders wanting different things.
Oh, absolutely. Conflicting objectives are pretty common now. One group pushes for climate action, another pushes purely for short-term financial returns,
Which leads us straight into the idea of corporate responsibility.
which is this concept that a company is accountable for more than just its financial results.
Yeah.
It has to consider its impact on society, the environment, other stakeholders.
Stakeholders meaning employees, customers, communities, not just the shareholders.
Precisely. And this forces that fundamental question. What is the purpose of a corporation today, especially facing huge challenges like climate change?
And ESG provides a kind of framework for thinking about that broader impact. Can we quickly define those three letters, E, S, and G?
Sure. So ESG is basically a set of criteria for looking at a company's non-financial performance. The E is environmental. How does the company affect nature? Climate policies, carbon emissions, waste management, that kind of thing.
Yep.
The S is social. How does it manage relationships with employees, suppliers, customers, the communities it operates in?
Yeah.
Think labor practices, human rights, product safety.
Right.
And G is governance. How is the company actually run? How is it led and managed? Board structure, executive pay, anti-corruption policies, transparency.
Okay, got the basics. Activism, responsibility, ESG. Now, let's dive into that deeper, almost philosophical debate this all sparks. What is the actual purpose of a firm?
Yeah, this takes us back to some foundational economic thinking. You really have to start with Adam Smith.
The father of free markets, what was his take on self-interest versus the greater good?
Well, in his big works, Smith explored how individuals pursuing their own economic interests, their self-love or self-interest, could maybe unintentionally benefit society as a whole.
The famous quote about the butcher and the brewer.
Exactly. It's not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own interest.
The market sort of channels that
Yeah,
self-interest.
that's the idea. His concept of the invisible hand. Individual actions in a free market, he argued, lead to a socially desirable allocation of resources. He even suggested the rich, pursuing their own interests, end up distributing necessities almost as if guided by this hand.
That specific idea, the rich distributing things via self-interest, gets used a lot to justify focusing only on profit.
It does. But, and this is really important and often missed, Smith's view was more complex. If you read his other major work, The Theory of Moral Sentiments, he talks a lot about broader moral principles: sympathy, prudence, justice, beneficence, self-command. He wasn't just about self-interest.
That's a crucial nuance, which kind of contrasts with Milton Friedman, whose view became incredibly dominant later on.
Very much so. Friedman, in that famous 1970 New York Times article, laid it out bluntly. The social responsibility of business is to increase its profits.
His argument was basically, stick to your knitting, make money for shareholders, follow the rules, and that's it.
Pretty much. Maximize profits for shareholders, operate within the legal and ethical rules of the game. And that view really shaped corporate thinking for decades. Shareholder value maximization became the mantra.
So that's the core tension right there. Shareholder value, pure financial return, Friedman's view versus shareholder welfare, this broader idea that includes non-financial impacts.
Exactly. And that tension is what's fueling so much of the evolving landscape of activism today, especially around climate change.
Climate change seems to be a huge driver here.
Undeniably. Look at the data. We talk about targets like 350 parts per million for atmospheric CO2. And NOAA data shows this clear correlation rising global temperatures tracking right alongside rising CO2 levels, especially since the Industrial Revolution, say 1850 to now.
And research has pointed towards corporate responsibility for a lot of those emissions.
Yeah, some significant studies suggest concentration. One piece of research indicated that just 90 companies were responsible for about 2/3 of historical industrial greenhouse gas emissions between the mid-19th century and 2010.
Who are we talking about?
Big names. Investor-owned ones like Exxon, Chevron, BP, Shell, and major state-owned companies like Saudi Aramco, Gazprom.
Which brings up the whole Exxon new controversy. What's the evidence there?
Well, it raises serious questions about transparency. Research published in Science in 2023 looked at ExxonMobil's own internal climate models from the 1970s onwards. It found their internal scientists were actually projecting warming trends pretty accurately, consistent with what independent academics were finding. But the study concluded that despite knowing this internally, the company externally quantifiably misled the public by sowing doubt about the science.
That gap internal knowledge versus public statements versus actual action, that seems critical.
It is. And it connects to this broader issue of corporate climate pledges versus what companies are actually doing. The Transition Pathway Initiative, TPI, tracks this.
What does the TPI data show?
For oil and gas, for instance, you often see a gap. Their stated targets, the dotted lines on the charts might look ambitious, but their actual reported emissions intensity, those solid lines, often tells a different story.
Examples.
Well, you might see Total Energies showing some decrease, ExxonMobil maybe staying pretty flat. Even companies like BP and Shell, who've made big net zero pledges, the data shows limited progress on actual emissions intensity reduction during certain periods.
So initiatives like climate action, 100 plus, investors pushing these high emitters, they're trying to bridge that gap.
They are. It's a huge coalition of investors.
Yeah.
But, questions remain about how effective it's really been, especially with the biggest oil companies.
And this goes back to what you said earlier, conflicting shareholder pressures.
Exactly. Not everyone's pulling in the same direction. Take BP again. Activist hedge fund Elliott Management built a stake and basically pushed BP to dial back its climate plans and focus more on oil and gas for better short-term returns.
And BP's leadership responded.
The CEO did announce a scaling back of some climate targets. Now, at the shareholder meeting, about 25% voted against this shift, a significant rebellion, but not enough to stop it. The chairman also left around that time, though they said it was pre-planned.
Wow, that's a direct clash. Financial pressure versus climate goals. The Danone case is another stark example, isn't it?
Absolutely. Danone, the big French food company.
Yeah.
In 2020, they became France's first large-listed enterprise mission. They legally embedded their social mission, health through food, into their company charter.
The CEO at the time, Emmanuel Faber, even said they'd toppled the statue of Milton Friedman.
Strong words. Directly taking on that profit-first ideology.
But it didn't last.
No. Just a year later, 2021, Faber was out, pushed out as chairman and CEO after pressure from activist investors, artisan partners, Bluebell Capital, who were hammering the company's financial performance under his leadership.
So even with a legally enshrined purpose,
The pressure for financial results from certain shareholders won out. It shows just how sharp that tension can be.
Okay, so to really get our heads around all these forces, activists, responsibility debates, profit versus purpose, we need to understand the underlying structure, the nature of the corporation itself.
It's fundamental. You have to understand the vehicle these battles are fought in. Let's go back a bit. Early business forms, like the Roman partnership, the societas, very different.
How so?
They pooled assets, shared profits and losses, sure. But the killer was unlimited liability. Partners were personally responsible for all the partnership's debts, sometimes even for co-partners' personal debts that affected the venture. Imagine being liable for thousands of strangers' debts.
Yeah, not appealing for widespread investment.
Definitely not. Then you get the early trading companies like the East India companies. The English ones started voyage by voyage. Invest, get paid, start again. Inefficient.
And the Dutch VOC.
They made a key innovation around 1606, permanent capital. Investors put money in and it stayed in. They couldn't withdraw it. Instead, they traded their shares with other people.
What did that allow?
Stability. The company could borrow more easily against that permanent capital. It could make long-term investments, like building trading posts overseas. This actually sped up trade cycles, even if the ships weren't faster.
But liability was still an issue.
Largely, yes. You had permanent capital, tradable shares, but potentially still unlimited personal liability for the company's debts, and maybe those of thousands of co-shareholders. Still incredibly risky for the average person.
So the modern corporation evolved to fix these problems.
Exactly. 5 core characteristics emerged over time that made large-scale enterprise possible.
Let's tick through them. First, legal personality or entity shielding.
This means the corporation is a separate legal person. It exists apart from its owners. Crucially, this brings entity shielding. The company's assets are protected from the owner's personal creditors. If you, a shareholder, go bankrupt, your creditors can't seize the company's factory.
Provides stability for the business itself.
Absolutely. And the corporation can sue and be sued in its own name, which raises all sorts of questions about corporate rights and responsibilities. It's social license from the state.
Okay, second characteristic.
Limited liability. This is the flip side. It protects the owner's personal assets from the company's debts. If the company fails, shareholders usually just lose their investment, their house, their savings, safe.
How does that change the investment calculation?
Fundamentally, with limited liability, the worst case for an equity holder is losing what they put in payoff, can't go to low zero. They're residual claimants. Debt holders have a fixed claim, but if the company folds, they might only get pennies on the dollar because they can't go after the shareholders personally.
Contrast that with unlimited liability.
With unlimited liability, your equity could be worth less than zero. You can owe more than you invested. And debt holders have a claim on your personal wealth. Much riskier for equity.
The Lloyd's of London example really hits this home.
It does. For centuries, Lloyd's used wealthy individuals and names with unlimited liability. It let them take huge risks. But then came the massive asbestos claims in the late 20th century. Many names were bankrupted personally. Lloyd's had to restructure, bring in limited liability corporate capital.
Okay, third characteristic. Transferable shares.
Simple idea, huge impact. Shares can be easily bought and sold, usually on public markets. This gives investors liquidity, a way to get their money out, even though the capital itself stays in the company permanently.
Are there ever restrictions?
Sometimes. Historically, linked to unlimited liability, you wanted control over who your partners were. Today, maybe in sensitive industries, national security, or sometimes as an anti-takeover defense. But generally, they're freely transferable.
Fourth, delegated management with a board structure.
As companies get big, you can't have thousands of owners running things day to day. So authority gets delegated to managers, overseen by a board of directors, usually elected by the shareholders.
Like a managing partner in a law firm?
Sort of, yeah.
Yeah.
And there are different board models. The one-tier board, common in the U.S., UK, mixes executives and non-executives. Shareholders elect the board appoints management.
And the other main type.
The two-tier board, Germany, is the classic example. You have a supervisory board, non-execs, sometimes worker reps, elected by shareholders, which appoints and oversees a separate management board, all executives. France offers a choice.
This whole setup is basically corporate governance.
It is the rules of the road for corporate power. How much power is delegated varies too. In Delaware, boards often approve deals between the company and a director. In the UK, shareholders might vote on that. And having the same person as chair and CEO, common in one-tier systems, concentrates a lot of power.
Right. And the fifth characteristic.
Investor ownership. Corporations, the kind we're mostly talking about, are owned by financial investors, shareholders, whose primary aim is usually a financial return.
As opposed to,
say, a cooperative owned by its customers or a law firm owned by its partners' employees. The ownership motive is different.
And in big public companies, this leads to that classic separation of ownership and control.
Exactly. Burley and Means wrote about this back in the 30s. In companies with thousands of dispersed shareholders, common in US, UK, Japan historically, the managers, especially the CEO, often held the real power. Corporate control means the actual power to pick the board.
How did CEOs maintain that control?
Historically, they often controlled the proxy voting process, nominating directors who would then reappoint them. Kind of like the Pope appointing the cardinals who will elect the next Pope. Independent directors are meant to counter that now.
But you said earlier most companies globally aren't widely held like that.
That's right. Outside that Anglo-American Japanese model, most corporations worldwide, especially in Europe and Asia, have a large controlling shareholder, a family, the state, another corporation.
And these controllers can sometimes punch above their financial weight, get more voting power than their shareholding suggests.
Yes, through various mechanisms. Cross-shareholdings companies, owning shares in each other, creating complex webs, stock pyramids, or corporate cascades. A holding company controls A, which controls B, which controls C. You can control the whole chain with relatively little capital at the top. The Bronfman Group in Canada used this effectively.
And dual-class shares seem very common now, especially in tech.
You issue different share classes with different voting rights. Class A gets 1 vote, Class B gets 10 or 20 votes. Founders and insiders hold the high vote shares, keeping control even if they sell down their economic stake. Google, Facebook, lots of tech firms. Even the London Stock Exchange allows them now, usually with time limits.
Yeah.
You could own, say, under 5% economically, but control 50% of the votes.
What about tenure voting?
That's different one class of share. But voting rights increase the longer you hold it. France has the Florange Act, giving double voting rights after 2 years in some cases. This benefits long-term holders, like families, and makes it harder for activists. Elliott's campaign at Pernod Ricard was hampered because their recent stake had much lower voting power per share than the family's long-held shares.
And Campari's moved to the Netherlands.
Similar idea. They set up a system where shares gain extra votes over time, up to 20 times the votes after 10 years. Again, heavily favors the existing controlling shareholder.
The argument is it rewards long-termism.
That's the argument. Yeah. But critics say it just entrenches control and dilutes the power of other shareholders, especially institutions who often dislike these structures.
Okay, so we have the concepts, the philosophy, the legal nuts and bolts, the ways control is structured. Let's tie it all together with a very current, very prominent case. Elon Musk and Tesla.
Ah, yes. Tesla. A microcosm of almost everything we've discussed.
Musk often talks about a bigger vision, right? Beyond just selling cars.
He does. His stated grand vision is Mars colonization, saving humanity. He claims this underlies his company's Tesla, SpaceX. Even the Cybertruck he suggested could be useful on Mars.
But alongside that grand vision, there are questions about Tesla's corporate responsibility on Earth.
Yes, things like product safety, the Cybertruck, recall for a loose panel, though Musk frames these as part of iteration. More seriously, self-driving vehicles.
Yeah.
There are safety concerns, but also reports suggest Musk wields significant influence on policymaking, potentially leading to looser regulations or even defunding of regulators in the U.S.
Which challenges Friedman's idea of just operating within existing rules.
Exactly. It suggests powerful companies might try to shape the rules themselves. Then there's worker treatment, with reports of unrest at the German plant, for example.
And then the massive controversy over executive compensation.
The $56 billion pay package. Huge opposition. Norway's sovereign wealth fund, NBM, clashed publicly with Musk. Proxy advisors ISS and Glass Lewis called it outsized, excessive.
But the shareholders approved it again in June 2024.
They did. Driven largely by retail investors, who own maybe 30% of Tesla, and support from big index funds like Vanguard and BlackRock. But many active managers like Nordea and CalPERS voted against.
Then a Delaware judge threw a spanner in the works.
Right. The judge invalidated the original 2018 approval, finding the process flawed, and the board too close to Musk, in thrall to its CEO, was the phrase. Musk called the ruling absolute corruption.
What was the board's rationale for such a huge package?
Retention and incentive. They argued it was needed to keep Musk focused on Tesla, especially as he threatened to develop future AI and robotics outside the company if he didn't get around 25% voting control. Now, Tesla might face massive accounting charges if the deal is ultimately voided.
And Tesla also just moved its legal home corporate redomiciling.
Shareholders approved moving incorporation from Delaware to Texas. Musk had already moved personally, partly for tax reasons.
Why leave Delaware? It's traditionally the place for big U.S. companies.
It is. Its specialized court of chancery and well-developed corporate law are usually seen as predictable and expert, favored by shareholders. The move is widely seen as a reaction to the Delaware court striking down the pay package, maybe seeking a legal environment perceived as more management-friendly, especially for deals involving Musk's other company, SpaceX.
Could this exodus hurt Delaware?
There's speculation. Reports suggest Delaware might be reviewing its laws, potentially softening them slightly, partly out of fear that more companies might leave for Texas or Nevada, states seen as competing for corporate charters.
This all highlights the ongoing CEO power and board dynamics at Tesla, too.
Definitely. Recent reports, like one suggesting the board was looking at potential successors for Musk, which the chair denied, show that even with a dominant figure like Musk, there's still scrutiny and internal dynamics at play. His power is immense, but perhaps not absolute.
So we've seen the concepts, the history, the legal structure, the real-world clashes in Danone and Tesla. This all fits into the broader trend. The whys and now maybe the backlash of ESG investing.
Yes, integrating ESG factors grew massively over the last 15-20 years, but now it's facing some pretty strong headwinds, especially in the U.S.
Where did this ESG movement gain momentum?
Key moments include the UN Global Compact back in 2000, getting businesses aligned with universal principles on human rights, labor, environment, anti-corruption. Then a 2004 financial industry report, Who Cares Wins, explicitly linked finance to these issues, grouping them into E, S, and G.
And that led to the UN Principles for Responsible Investment.
The UNPRI, launched in 2006. It gave investors practical principles. Signatories commit to things like incorporating ESG into investment analysis, Principle 1, and being active owners, Principle 2. That means engaging with companies, voting shares, filing resolutions, maybe joining collaborative efforts like Climate Action 100+ free. It grew hugely.
But now there's this ESG backlash.
Very much so, particularly visible in the U.S. political arena. You saw shifts during the Trump administration perceived as anti-ESG. More recently, large asset managers like BlackRock have faced lawsuits and intense pressure from Republican-led states.
Accusing them of what?
Basically, of prioritizing ESG goals over their fiduciary duty to maximize financial returns for state pension funds. BlackRock and others have made concessions pulling out of Climate Action 100+ battle, promising more transparency on voting, and some suits have been dropped.
And there's anti-ESG legislation being proposed.
Yes, tracked at state and federal levels. And groups like Climate Action 100+ have faced scrutiny from Congress, accused of potentially being an anti-competitive climate cartel.
Amidst all this, you've emphasized the crucial role of asset owners.
Absolutely critical. They are the ones who actually own the money. The giant pension funds, sovereign wealth funds. Asset managers like BlackRock work for them. The asset owners set the investment mandates, including whether and how to incorporate ESG.
Who are the big global players?
Japan's GPIF is the world's largest pension fund. They outsource management but set the strategy. Norway's oil fund, NBIM, is second largest, known for direct engagement under a government mandate.
And U.S. public pension funds.
Huge influence. CalPERS and CalSTRS in California are major forces. New York City and state funds, too, often with activist controllers like Brad Lander pushing ESG.
And politics plays a big role there.
Definitely. For public funds, the political leaning of the state government heavily influences the ESG stance. So-called red states push back against ESG mandates. Blue states often promote them. This directly impacts how asset managers are instructed to vote and engage. You also have influential international funds, Netherlands, Canada, Australia, and even players like the Church of England Pension Board in the UK, which has been quite proactive.
Okay, we've covered a massive amount of ground. Corporate purpose, legal structures, activism, ESG, specific cases, the political pushback.
And hopefully you can see the connections. Activism uses the corporate structure. Debates about purpose fuel ESG demands. The legal framework dictates how power works. Cases like Tesla show the friction. And the ESG trend reflects broader societal shifts in political battles.
So bringing it back home, why does understanding all this intricate stuff matter?
Because these forces shape the companies we interact with every single day, as employees, as customers, maybe as investors ourselves. Understanding this helps you see why companies act the way they do, what pressures they face, and how that fundamental tension between shareholder returns and broader societal or environmental impact plays out. It affects everyone. It's about understanding the engine room of modern capitalism, really.
It's definitely a complex and constantly shifting landscape.
No doubt about it.
Well, thank you for joining us on this deep dive into the world of shareholder activism and corporate responsibility.
A really vital conversation to be having.
So, considering everything we've discussed today, that inherent tension between financial returns for shareholders and these wider impacts on society and the environment, what do you, our listener, think is the ultimate true purpose of a corporation here in the 21st century? How should companies balance these competing demands going forward? Until next time, keep exploring.